in January from 4.4% in December. By contrast, firms' cost of issuing market-based debt rose to 3.7%, 0.2 percentage point above its December level. Over the same period, the average interest rates on new mortgages declined to 3.3% from 3.4%. Growth in bank lending to firms rose to 2% in January, up from 1.7% in December, on the back of a moderate monthly flow of new loans. Growth in debt securities issued by firms rose to 3.4% in annual terms. Mortgage lending continued to rise gradually, but remained muted overall, with an annual growth rate of 1.3%. So in conclusion, the Governing Council today decided to lower the three key ECB interest rates by 25 basis points. In particular, the decision to lower the deposit facility rate through which we steer the monetary policy stance, is based on our updated assessment of the inflation outlook, the dynamic of underlying inflation, and the strength of monetary policy transmission. We are determined to ensure that inflation stabilizes sustainably at our 2% medium-term target. Especially in current conditions of rising uncertainty, we will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions. Thank you.
And the first question today goes to Alex Weber of Bloomberg. Alex, please.
Let me grab some water.
Thank you. Good afternoon. My first question is on the way forward. So you say that your monetary policy is becoming meaningfully less restrictive. Does this mean you could slow the pace of rate cuts now and perhaps pause in April? Did you discuss such a scenario at your meeting today? And my second question, perhaps related to that, is on fiscal policy. There's a pretty drastic shift underway with plans for much higher defense spending, and in Germany's case, also infrastructure. There's been a significant market reaction as well. Could you elaborate how the Governing Council expects this to change the economic outlook and monetary policy?
Thank you very much for your two questions. So on your first question, you very well noted that we have changed the wording of the fourth paragraph of our monetary policy statement. So let me try to explain what it means, because it's not just an innocuous little change. It's a change that has a certain meaning. What we had previously was that we would keep our restrictive monetary policy as long as was necessary, etc. And that was very much a static assessment of what was needed. We are now moving, by having our monetary policy is becoming meaningfully less restrictive, to a more evolutionary approach. So in other words, we take account of the journey that we have traveled, 150 basis points since we started cutting. And we acknowledge the fact that, as a result, it is becoming meaningfully less restrictive. We add to that in the same paragraph the two forces that we are seeing operating on our financing conditions. And the first one, if you will, is the... I used a comparison a few weeks ago when we were at the G20 in South Africa. And I use the comparison of the Cape of Good Hope, where you have warm water from the Indian Ocean and the cold water from the Atlantic. And this is really where the position is at the moment, where we have the impact of the current monetary policy decisions that we take and have been taking, which is to cut rates. But at the same time, we still have the cold water of the Atlantic, meaning the remaining effects of decisions that we have taken over the course of time. And that's really where we are at the moment, and that has led us to acknowledge the fact that our measures, that our monetary policy is becoming meaningfully less restrictive. So you asked me the second question, which has to do with most recent development. And I have to say that we have not been spared recent developments in the last few hours and days. And the one that you're referring to is the announcement by the European Commission, on the one hand, of this 800 billion comprising the 150 borrowing facility and the 650 space within which member states can borrow for defense purposes, on the one hand. And on the other hand, the announcement by the German authorities of a twofold program, in a way, one which is the big infrastructure financing of 500 billion over a period of 10 years, and a special measure that relates to defense expenditure that would be decided in the years to come. So 2 observations. One is, this is work in progress. And we have to be attentive, vigilant. We have to understand how this is going to work, what the timing will be, what the financing will be, so that we can then draw the conclusions and appreciate how much it will contribute to growth and what impact it would have eventually on inflation. So that part of the work we have not yet, of course, determined the conclusion. But one thing that around the table of the Governing Council was clear is that on both accounts, that would be supportive to European growth at large and would be a boost to the European economy. Now, everything is going to be a factor of the details. You know, where will the purchases take place? What will the timing be? What will the financing be? And all of those are, you know, obviously political decisions that are not within the remit of the central bank. But we are very attentive to what will come out of today's meeting in Brussels and further development on the German political scene to appreciate the economic consequences. Thank you.
Next question goes to Annette Weisbach of CNBC. Annette, please.
Madame Lagarde, I have another question on the meaningfully less restrictive monetary policy stance. Perhaps you can explain that to us. Lending is still down. So what makes you think, the ECB think, that the monetary policy stance is actually less restrictive? Because it seems that companies are still holding back to actually borrow and invest. So my second question would be on the pause, which is likely or not in April. Given the uncertainties, would you rather wait for more wage data coming in, as domestic inflation seems to be stubbornly high? Thank you.
But thank you so much for your question. You know, our assessment, based on the bank lending survey, based on the numbers that that we receive, based on the corporate survey that we hold, and comparing the current situation with the last few quarters, and this month versus last month as well, indicate that lending is actually increasing. The lending to corporate is up by 2%. The lending to households in terms of mortgages is up by 1.3%. Now, this is not yet bringing us to, you know, the sort of strong, solid, robust levels of borrowing by economic actors, but it is definitely on the way up. So you have 2 phenomena. You have interest rates that we see going down, both for corporate and households, not phenomenally yet. We hope that that process will continue. And we are seeing at the same time the volume of lending going up as well. So that's on those two accounts, which it's one of the elements that we use to determine whether or not and how much we are or not still restrictive. And we're not really sort of passing judgment, because I think that particular point is not necessarily the most relevant. What we acknowledge is that it is becoming meaningfully less restrictive. And as I said, we take into account all the work that has been done and we assess the process that we are in. You asked me a second question.
On the potential April 4th and wage data.
Oh, okay. Yeah, you know what? That gives me a chance to explain to you where we are. And I think there is a particular sentence in the monetary policy statement which refers to the particularly high uncertainty under which we operate. Because, clearly we have three phenomena that we have debated over the course of this Governing Council. One, the disinflation is on track. That's point number one. Point number two, the monetary policy is becoming meaningfully less restrictive. And point number two, we have huge uncertainty. Some people have used the adjective phenomenal uncertainty, and we debated as to whether it was high and rising, but suffice to say that it is all over. So we have risks all over, uncertainty all over. So under those circumstances, our determination is obviously to reach destination. But we will do so without pre-committing to any particular path. And you have seen that sentence in our monetary policy statement in the past. I think it is even more relevant at the moment, given the level of uncertainty that we have. So we are not pre-committing to a path. And you might have some governors who will say that, I believe that. It is their individual views. I can assure you that the collective view around the table is that we do not pre-commit to a path. And we will be, as ever, and probably more so, data dependent. So if the data indicates to us that in order to reach destination, the appropriate monetary policy should be to cut, we shall do so. But if, on the other hand, the data indicates that it is not the case, then we shall not cut and we will pause. So that's really where we are, not pre-committing, being data dependent as ever, and deciding on a meeting-by-meeting basis. So I know some will find it frustrating, but I'm terribly sorry. But in the circumstances we're facing at the moment, anything more would not be very responsible. From one day to the other, the situation changes dramatically. And our projection, the measure of underlying inflation, the price of energy, you just name it. Risks are all over the place.
Francesco Canepa of Reuters for the next question. Francesco, please.
Good afternoon, everybody. So,
Good afternoon, Mr. Panetta.
You said in the past that the direction of travel was clear, and the only question was about the pace and timing. There was also a mention in the past about inflation reaching target over the course of this year. Now, those are gone. You didn't repeat those today. So I just wanted to ask you, how broad was the consensus behind today's rate cut? The second question is about something else, is about Russian assets. There seems to be growing political appetite in Europe for seizing those assets. Now, obviously, that would set a legal precedent. So I wanted to ask you, how do you think that would affect the status of the euro as a reserve currency? Thank you.
Thank you for your two questions. So it gives me a chance to tell you how the decision was made. And it was made as a result of substantive discussion all around the table on the state of the economy, on our projections, on the risks that we are facing. And the decision was a consensus, and no one opposed that decision. Or you might have different source of information, could be. But I was sitting in the room, you see, mind you. So no one opposed the decision. One governor, specifically Governor Olsman, for whom I have great respect, abstained. Okay? There was no opposition. There was one abstention. So you have the gist of the decision. Look, on the Russian assets, I think we have made our position quite clear in the sense that those frozen assets, as you know, are being used in order to guarantee 50 billion loans granted under the ERA by the various members of the G7. This process is underway, and there are political debates that are vastly broadcasted around the fact that we should maybe move from freezing to seizing. This is not for the European Central Bank to debate, but I would certainly submit that the international law basis on which any decision is made will matter as far as other investors are concerned. And it is, I'm sure, an element that will be taken into account by those whose job it is to make those ultimate decisions.
Next question goes to Johanna Treek of Politico. Johanna, please.
Good afternoon. Thank you very much.
Good afternoon.
I would like to go back to your previous assertion that, you know, there might be a question about the speed of travel, but the direction is clear. So from today's perspective, is the direction of travel still clear? There's only one direction. And my second question is on the recent market reaction. Borrowing costs have gone up in response to the fiscal news. Do you have any concerns about a return of sovereign debt tensions in the Eurozone? Thank you very much.
Well, thank you very much. I think I have tried to explain in the previous answer to the question that the situation that we face at the moment is predicated by this disinflationary process that is on track and confirms broadly the estimates that staff has made over the course of time, and without much error, by the way, most recently. Second, that our monetary policy is meaningfully less restrictive. So we have covered 150 basis points of ground. And three, and that's probably the most important in relation to the question that you've pointed at me, the landscape that we have at the moment is clouded with uncertainty, okay? And more than ever before, it will require that we be vigilant. So all governors, all the national central banks, all the economies that are scrutinizing the developments and the work that is conducted in each of the national central banks, as well as at the ECB, each of them will continue to scrutinize, and we will all have to be extremely vigilant. We will have to be agile to respond to the data. But as I said, if the data indicates that the most appropriate monetary policy stance is a cut, it will be a cut. If, on the other hand, the data indicates that the most appropriate decision is not to cut, then it will be a pause. I think I have been as clear as I could be on that one. You asked me a second question which had to do with the markets. You know, we look at all market developments and we are very attentive to what's happening, and we try to understand the reaction function of markets. And clearly there has been a lot of reaction in the last, particularly in the last 12 hours, 24 hours, including yesterday. But we're not going to be changing a policy stance as a result of a market determination of the last 24 hours. Equally, when we look at the spread, there's been very limited spread variation despite the massive change in the yields. So I think that that gives us an answer concerning the solidity of transmission and the solidity of the sovereigns around Europe. Thank you.
Next question goes to Olaf Storbeck of the Financial Times. Olaf, please.
Thanks. Following up on the last question, so your answer is that the direction of travel isn't clear anymore. Would that be the kind of short version of your elaborate answer? That would be my first question. And my second question is, you pointed to the potential increase in infrastructure and defense spending, which could both add to growth and to inflation. Did you have any discussion in the Governing Council which of the two things are potentially the more relevant one looking forward? And do you have any views yourself on that, given what we know so far, what governments are planning to do? Thanks.
Now, on your second question, I know you all want to move faster than light, and certainly faster than our brain power collectively can determine. And as I said, those announcement dates from yesterday, and honestly, in 24 hours, our staff, despite the great work that they do and despite the agility that they demonstrate, particularly those times, are not in a position to identify how much it will contribute to growth and to the European GDP, nor are they in a position to identify how it will impact inflation. Intuitively, all of us around the table, the governors, believe that if all that works, and that's a big if, because it needs to be decided, it needs to go through the parliamentary channels, it needs to then be implemented, by the way. If all that works, it will boost growth. But more to come. Frankly, I think that we need to be attentive to the coming days, weeks, and then try to anticipate the economic consequences that it would have and how it would be distributed as well. On your first point, the reason I'm giving you, I gave Mrs. Streck a quite elaborate answer, I'm sorry for that, it's because the situation is not as sort of straightforward, black and white, we go here, we go there. No, it's not what we're facing at the moment. And as I said, repeatedly, we are not pre-committing to any particular rate path. Okay? We will be data dependent more than ever, and we will decide meeting by meeting. One thing is really clear for me, because you asked me my view, is that we have to reach our destination. And let me just mention one thing, because some of you might be attentive to when we reach that target of 2%. And if you look at the projection of staff that you will see, it's very early in 26, not late in 25. And that is so because of energy prices. Staff has considered that on the basis of the cutoff date that they have, which was quite a few days ago, it was legitimate on the basis of future prices, both on oil and gas. It was legitimate to probably increase by 0.2% the inflation projection. If you look at energy prices today, whether it's oil or gas, the impact would be seriously different. So that gives us, the dimension of uncertainty that we have and the many risks that we have to look at. It's energy prices, it's trade policy, it's potential retaliation, it's massive investment programs, it's a lot of variables that we have to be attentive to, that we have to be vigilant about. But there are certain things that are solid and stable and actually, fall in line with the projection and anticipation of staff. If you look, for instance, at wages, if you look at the labor market, that is really moving in line with what we had expected. The same goes for services. So there are some stable elements. You remember, those of you who were here last time and the monetary policy meeting we had before, I said I'm particularly attentive to the price of services. I'm particularly attentive to the domestic underlying inflation. I'm particularly attentive to wages in all their dimensions. And that is heading in the direction that we had anticipated, which is comforting the work that we've been doing.
Next question.
I know it doesn't make a headline, but hey.
Now, Aude Kazulek of the French television channel BFM Business. Aude, please.
Good afternoon. You've said in the past that monetary and fiscal policy must work hand in hand. Concerning defense spending, do you think this investment should be accompanied by accommodative financial conditions? And second question, related to uncertainty and risk, especially geopolitical ones, do you consider that we are in a whatever it takes moment, as said by Mr. Metz a few days ago? Thank you.
Well, thank you very much for your question, your two questions. So on the first one, as I said, it's work in progress, but if the proposal by the Commission for massive borrowing programs and exemption under the escape clause and the two proposals identified by future Chancellor Merz, if all that was to work, it would certainly have a fiscal impact, which itself would have an impact on demand. So we will have to take that into account and factor that in. But I don't see that as related to our monetary policy, because our monetary policy, as you know, provided under the mandate that we have under Article 127 of the treaty, is price stability. And we're going to really adhere strictly to our mandate of price stability. We are attentive to transmission. We are attentive to underlying inflation. We are attentive to the inflation outlook. And all of that is informed by a large amount of data. But, you know, if your question is intended like, would you not participate in a financing effort? This is not the purpose of the ECB, okay? There's a European Investment Bank. There are multiple institutions whose actual purpose it is. Our purpose, our mandate is price stability. On your second questions...
whatever it takes.
Yeah. Geopolitical risks, on the one hand, determination by policymakers on the other hand. So it's really something that is in their hands, and because it will contribute to boosting the European economy, because hopefully it will be a source of innovation. Typically, investment in defense are a source of innovation, therefore will improve productivity. We are very attentive to that, and we are hoping that it will have those impacts on the European economy. Is it a whatever it takes moment for the German economy? It's not for me to say. It's for the political leaders to appropriate that expression. Thank you.
And now Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you for the opportunity. President Lagarde, I have two questions. The first is on quantitative tightening. The ECB has been carrying out QT for quite some time, and if I can use your metaphor, it is a bit of a cold water, I think, in the flows. And so we had TLTRO's repayment stopping, and then the holdings, their investments of APP and PEP. So QT has been continuing during the interest rate cut cycle, and it is taking place now together with a kind of a market tightening, the sharp rise of long-term yields of government bonds. So is the Governing Council taking into consideration or quantifying the impact of this QT on its monetary policy and this meaningfully less restrictive monetary policy? And then my second question is on digital euro. Because the Trump administration decided to stop the Federal Reserve's project on central bank digital currency. And it looks like the Fed might be on hold on digital dollar for about 4 years. And so it looks like a kind of a golden opportunity for the ECB and the plans of the digital euro. What is the position of the ECB on these issues? I mean, these changes also from the United States, and how can the ECB push forward with the creation of a digital euro? Thank you.
Thank you very much for your two very different and both important questions. So you are perfectly correct in that we have stopped reinvesting quite a while ago now under the APP. We've stopped reinvesting gradually over the course of time under the Pandemic Emergency Purchase Program, and all TLTRO reimbursement have now been refunded. But this is a process which has taken place very smoothly, which has been absorbed by markets in a very innocuous way over the course of time. Now, we don't regard that as a component of our monetary policy primarily. It's operating on the back burner, if you will. It has been telegraphed very early on. We have anticipated, communicated to markets so that it happens in a very, very smooth and gradual manner, which is what we are seeing. The main monetary policy instrument that we have used recently and that will be the driving force is interest rate, not QT or otherwise such financing program. I know that we have to calculate everything. So we do calculate, we do try to work with counterfactual, and you well know that my dear colleague Piero Cipollone has tried to assess exactly how much it contributes or not, and this is something that he has had calculated. But it's not our key instrument, and it's really not perceived as having a significant impact. On your second point, I tend to share your views. Nature doesn't like vacuum. And we started working on the digital euro way back, actually when I started my term 5.5 years ago. And I'm not claiming, parentality on the digital euro, because my colleague Benoît Cœuré had already committed a speech on this matter before I arrived. But I certainly carried on with that project, and subsequently Fabio Panetta on the board and then Piero Cipollone, who has replaced Fabio, have taken the lead together with a very, very good team which is focused on accelerating the pace and hopefully campaigning enough with all the stakeholders, meaning European Parliament, meaning European Council, meaning European Commission, so that we can eventually, not put to bed, but put to reality this digital euro. The deadline for us is going to be October of 25, and we are getting ready for that deadline, but we will not be able to move unless the other parties, the stakeholders, as I call them, Commission, Council, and Parliament, actually complete the legislative process, without which we will not be able to move. And I think it is critically important, and it seems to the agnostic or the skeptics, it seems to be more relevant and more of an imperative now than ever before, both on the wholesale and on the retail level, both.
And Andres Stumpf of Expansion. Andres, please.
Thank you. Could you guide us a bit more around today's discussion and the consensus and frictions? Do you see more diversity of views regarding the current economic outlook or regarding the medium-term outlook? And second question, after what we have seen these last weeks, do you still believe that negotiations are preferable in relation to tariff and commercial war, or has Europe to show somehow some strength? Thank you.
My personal
your personal view.
Yeah. My personal view is that you have to negotiate from a position of strength. So one thing leads to the other. And that's the hope that I can formulate, because we know that tariffs, and particularly if there is retaliation, are not good at all and are net negative on pretty much all accounts. But that's my personal view. Although I think we around the table of the Governing Council, we all agreed that it was net negative if it when it happens, and it's even negative before it happens, because the uncertainty that is generated and the undermined confidence that results from just the threat of those tariff increases and potential retaliations are putting a brake on investment, on consumption decisions, on employment, hiring, and all the rest of it. What can I tell you about the discussions? We had quite extensive, intense, lively discussions, but I don't think that we can draw a line between the short term and the medium term, because obviously what is the developments that we are seeing at the moment, because of how they will transform the outlook, because of the impact that it will have on our societies as well as our economies, both in terms of growth and in terms of inflation and in terms of employment, and in terms of transformation of Europe. Those are significant changes, essential changes that we are witnessing and for which we have to account to help making the best and the most appropriate monetary policy decisions. But everyone was very engaged, as you can imagine.
That concludes our press conference today. Thank you very much for following us. Our next press conference is on April 17. Until then, all the best. Thank you.
Lagarde talking for quite a long time as we watch markets here in the U.S. fall significantly. I'm Matt Miller alongside Katie Greifeld and Sonali Basak, and we are seeing a sell-off on the NASDAQ of more than 2% right now after Marvell Technologies came out with a disappointing outlook and, I would say, still on concerns about the Trump trade war. Katie, what are you watching?
Yeah, let's get to these intraday boards. We're about 7 minutes into the session, and it's pretty ugly out there. You have all 11 sectors lower right now on the S&P 500, which is firmly in red territory for the year. The sell-off really is concentrated in big tech. As you can see, the NASDAQ 100 down about 2% at the moment. Chip stocks leading the way lower, and the small caps obviously not escaping the sell-off either. The Russell 2000 down about 1.7% at the moment. It's just all over the screen. Red right now. Let's take a look at some stocks to keep an eye on under the surface. As I mentioned, chips in focus right now. NVIDIA erasing yesterday's gains as concerns around the chip sector mount from earnings, trade uncertainty, and competition out of China. The auto sector also down today. That's despite some relief on the tariff front that we got yesterday. As you can see, Sonali, no one spared right now.
Yeah, it really is across the board. I want to go back to what Matt was saying about Marvell just to see how much it is dropping as the market opens. We are seeing now a drop. Ooh, brutal, more than we saw pre-market, almost 20% lower. And remember, they're not the only one. You had a lot of movement in CrowdStrike as well, MongoDB. So all across this tech sector, some tough news out of earnings alongside that China threat that you were talking about, Katie. We'll talk more about tech in just a minute here because retailers too, Matt, are taking a hit.
Yeah, absolutely. Macy's joining the growing list of retailers to issue a disappointing outlook, pointing to cautious consumers and uncertainty surrounding potential tariffs, plus Walmart asking some of its suppliers, Chinese suppliers, for discounts in an effort to offset Trump's tariffs. So it's not just a concern on the technology front as U.S. tech companies put out disappointing outlooks and Chinese tech companies seem to be firing on all cylinders. It's not just about trade concerns, although that leaks into retail as well with Walmart's request. It's really about a growth scare as well. And this is something that you've been talking about a lot of the past couple of days, Sonali. People are starting to use the word recession a lot more often in the past couple of days than they have in the past couple of months.
A cocktail of words to be a bit afraid of, which is recession, stagflation, inflation, and consumer weakness. And those are the things everyone's parsing. Tough jobs data earlier this morning as well, but we're going to talk more about the stock market, I know, right now, before we get to those macro concerns.
Absolutely. Well, we have the big one tomorrow. That's the NFP print. On the retailers, though, you think about Macy's, Target, Best Buy, Walmart, 2 weeks ago, did the same thing. Good results to report, but you take a look at the outlook, it's pretty bad. You could say the same about the tech sector, too, because as Gina Martin-Adams reminded us, you think about the cost of goods sold for these big tech companies, a lot of that is coming from outside the U.S.
Yeah, absolutely. Speaking of the tech sector, let's take a look at the Philadelphia Semiconductor Index. It is currently, well, the NASDAQ, you can see there, down 1.75%, but the SOX index is down 3.5% right now. This is because of Marvell's forecast miss, or disappointment, I should say, and Alibaba's AI model that could rival DeepSeek. We're hearing a lot from Chinese companies, including Tencent, including Kuaishou, which means fast hands, as I just learned in Chinese. Let's take a look at the tech volatility with Bloomberg Technology co-host Caroline Hyde. And Caroline, the Chinese are really playing a big part in this.
They are, and they're showing that you can do more with less. We're seeing less data necessary, less compute power necessary, and still incredibly sophisticated AI models. You mentioned what's coming out of Alibaba. They're really leading the charge, and remember, they're committing more capital, $52 billion of investment, and also a national focus on this. We heard from the Chinese government saying they're pouring their focus into generative AI. You've then had, as you mentioned, Tencent with a video model coming out to compete against a Sora, whereas Alibaba takes on the latest generative AI models from the likes of OpenAI and indeed the local DeepSeek. And then you've got one called Manus AI, shout out to our colleague Manus, but there's one called Manus AI that seems to be beating across the board when it comes to also the O1s of this world from OpenAI. This is fearful. This is a worry that you therefore need yet less compute, less sophisticated chips, and it sucks up all of that enthusiasm that we've seen in the AI trade. We've got so much nervousness going on when it comes to the semiconductor index. Marvell losing $15 billion worth of market capitalization. People are selling their winners. Marvell pointed to 60% growth in revenue for their next fiscal quarter. That is not good enough for the investor base. They wanted more.
You know, speaking of Marvell, the SOX, the Philadelphia Semiconductor Index, is down, I believe, more than 8%, almost 9% now. The S&P 500 is also down on the year. But you look at the movement in the SOX index, and I'm wondering if this is the tail wagging the dog here. This is an index that is really underpinning a lot of the artificial intelligence boom. Yes. You're seeing the NASDAQ down today as well, but do the troubles that you're seeing in the semiconductor index give you signs of more pain ahead, Caroline?
It certainly doesn't. Remember, we got Broadcom's numbers after the bell today. Jordan Klein Mizuho putting out great notes throughout all of this, just being like, this isn't about fundamentals. This isn't about what earnings are going to be shown or what management tell you. This is about wanting to get out of AI at the moment. We've been over-indexed towards it. People are pulling back, and therefore you're likely to see semiconductors hurt the most. But it's interesting that software companies are hurting today as well. MongoDB showing that we're worried about growth focus there. There is a growth scare upon us. There is a worry about Chinese competition. And indeed, semiconductors have been your key winners, and therefore you sell them. Nvidia is down, Broadcom is down ahead of their earnings, and the likes of Marvell. Really, there's no place spared when it comes to technology right now, and you are not going to be paid back for any sort of risk-taking in this moment.
All right, great context as always. That is Bloomberg Technology's Caroline Hyde. Much more coverage from Caroline coming up at 11 a.m. But let's keep this conversation going now on this sell-off with Alessio de Longis. He is head of investments at Invesco Solutions, joining us on set now. Always great to see you, Alessio.
Great to see you.
So I want to pull up a chart for you, and that is the year-to-date performance of the Euro 600, the stock 600 versus the S&P 500 year-to-date. You can see that just looking at this chart, you could easily make the case that American exceptionalism, that trade is over. We were talking about growth concerns, inflation fears, all of these worries culminating in that chart before us. How much faith do you put into those arguments? How much water do you give to the idea here that America first in these markets is over?
I put a lot of conviction in this idea, but it's important to make a clarification. It's about focusing not on the change in the fundamentals, but in the change in expectations, how much expectations were extrapolated. U.S. exceptionalism, when you look at the economic statistics, the productivity, the ability of the U.S. economy to grow, it's unquestionable. There is no expiration date as of today relative to Europe or relative to emerging markets as we know them today. But the problem is that for the last 15 years, the markets tend to, after a prolonged period of time, as I mentioned, 15 years, they tend to extrapolate the ongoing growth and widening of that exceptionalism story. That's what's coming to an end. It's between tariffs, between the news of defense spending and fiscal stimulus out of Europe. When was the last time we talked about fiscal stimulus out of Europe versus fiscal conservatism in the US? You add to it the increased competition from emerging markets with respect to AI landscape, and all of a sudden, all of the reasons to continue to extrapolate monopolistic conditions out of US tech have been wiped out. What are you seeing? You mentioned it earlier. You're not seeing the long-weighted rotation from tech into US small and mid caps, right, because you're seeing these sectors that have high operating leverage are now fearful of a recession risk. What you're seeing is reduction in US equity exposure and going into international, which has been shunned and underweighted for
Yeah, I mean, to that point, Alessio, we're looking at a loss for the S&P on the year, down more than 2%.
We're down below the election now.
We're down below the election and down for the year. We're down on the NASDAQ 3.5% year to date, more. And then if you look at Europe, the DAX is up 22%. The IBEX is up 19% in Spain.
Wow.
The French stocks are up 16% on the CAC Carin. What kind of legs does this European rally have? Can that continue?
Relative to the US, we believe it can continue and probably will continue. But it's a relative trade, right? Because if we do get rising probabilities, rising concerns of meaningfully slower global growth, the overall global equity market performance will dominate over these relative value trades. So we do believe, and we have pushing our clients to reconsider their massive underweight exposures to international markets for the last 2 months. It's about that relative trade that we believe still has legs. Let's not forget that there's going to be also an enormous currency component. Yield differentials have just compressed by about 100 basis points in 2 months on US versus European bond yields. The euro has risen 5%. Talks of euro parity are gone. When you look at fair value metrics on the euro, we could easily be at 130 in a couple of years. These are big deltas in repositioning across global equity markets.
You know, it's crazy. We are on track now for the S&P 500 this week to be down 3.4%. That's just at this moment. We'll tell you pretty soon when is the last time we saw that. I think it was April of last year. So it's certainly been a while. You know, recession risk, you talked about it a little earlier. How serious is this, especially when the data that we might get ahead will be so choppy? You can imagine a bit of a trader freak out when you think through how much you might see in volatility in jobs numbers alone.
We will see a lot of noise in the data for the reasons you just mentioned. Growth outside of the US is already well below trend and at risk of seeing meaningful downgrades. The US has carried the baton so far. From my perspective, it's still too early to call for an outright recession, and there's only one barometer that I would be looking at on a day-to-day basis for that confirmation, and that's high yield spreads.
Okay. Alessio, I don't know how much stock you put in technicals. It feels like one of those things we reach for when the fundamentals get really ugly and we're not sure where to go. So let's look at the technicals right now. The S&P 500.
I'm with you, Katie, on that. I put very little stock in technicals.
It's a little bit like astrology, but it feels like a proper moment. And we have this beautiful chart to show you. You take a look at the S&P 500. It's testing its 200-day moving average. We haven't done that, actually, since late 2023. And it feels like this chart really reveals whether you're a bull or a bear, because you could say we're going to bounce off that support, or you could say we're going to break below it and there's more losses to come after that. How do you read that chart? So, and clarifying that technicals are not my thing, so that I won't be speaking to them in an informed way, but I do think that they give you an indication of that stretched sentiment or normalization in sentiment. In other words, just statistically speaking, markets, just look at the chart, right? Markets need to trade above and eventually return below that whatever moving average we're looking at. Those moving averages are giving you an indication of the fundamental trends. And the deviations from those moving averages are giving you an indication of how much has been priced ahead or in excess of that fundamental trend. So one way from a fundamental perspective to read that chart is to say, we know the fundamentals have been improving, right? We have run well above those, and now we are repricing back to where
an average fundamental would have been. So my take would be that we will breach that 200-day moving average. How sustained and how meaningfully, I go back to credit spreads, because you need something to break to feed then a correction into a negative momentum.
I'll give you another reason, Katie, to focus on the technicals in this market, and it's quants being king. You have a lot of quantitative trading. You have a lot of factors that are being traded on, momentum in particular, and the momentum right now is to the downside.
Yeah, good point.
Anyways, Alessio de Longis of Invesco Solutions, we thank you so much for your time and giving us things to look at very specifically. Keep an eye on those spreads. But coming up, we're keeping an eye on the IPO market because it's starting to defrost. Amid all of this uncertainty, there are more U.S. listings just around the corner. We're going to talk about how that's possible in this market next in the Wall Street Beat. This is Bloomberg.
Welcome back to Bloomberg Open Interest. A sell-off underway on this Thursday. We're just a couple of days into March, and boy, it has been an ugly month. That continues today with the S&P 500 now down about 1.3%. The NASDAQ 100, your big tech, off the worst levels of the session, still down 1.6%. Small caps, too, joining in on this sell-off, Sonali, down about 1.4% on the little guys.
Just brutal. We'll keep an eye on it. But it's time now for the Wall Street Beat. Today we are looking at the IPO market because a number of companies are preparing to hit the market in coming weeks, including Klarna, which is a long-awaited $1 billion deal set to file as early as next week. Joining us with a look, Bloomberg's Bailey Lipschultz. The problem is that you have a VIX now touching 24. We talked to the New York Stock Exchange president a little earlier this week. 20 is a problem for the IPO market if it's sustained. How are these companies supposed to shake off this volatility as they head to market?
No, I think that's the big concern. And when you look at some of the commentaries, you mentioned Macy president talking about 20 as being the sweet spot, and we've seen bankers talk about that. One thing to keep in mind, Sonali, we've been essentially below, outside of that yen carry trade freak out and post-election, below 20 for like 2.5 years at this point, and we still haven't really seen deals. The big question, though, is how do you price a deal when your comp set is rapidly moving? When you mentioned Klarna, a firm is down about 30% in just the last 2 weeks. That's their best comp. So if you're going to be pitching Klarna to investors, if I'm a buyer, I say, well, a firm's down 30%. So what does this deal look like relative to where we were 2 weeks ago?
Right, like in weaker consumer sentiment environment, I'm hearing from bankers that roadshow is getting smaller and smaller just to get deals out the door faster and not get hit with that volatility.
A firm, though, was up in 2023, was up in 2024. The S&P was up 25% basically in both of the last 2 years. Why didn't we have more IPOs as the market was outperforming like every hedge fund, making everyone rich, and nobody was willing to come to market?
Well, that's the debate, right? So S&P 500 up 24% in 2023, up 23% in 2024, to your point. If I'm an
I was rounding up.
I know, but if I'm an IPO buyer and you're pitching me on a new deal, my counter is, well, I can still get 4+% in free returns on safe debt, and also if I just buy the Mag 7, I'm returning 50%. Like, how much of a discount can you give me?
I guess the big mega caps were squeezing out the new IPOs.
They were squeezing it out, but there still was so much of a debate of what valuation are you actually going to get? Because if you have to bring a deal at a 30% discount to your best comp as an IPO seller, you're taking a haircut because you probably can't see into 2025. So you're lowering your own estimates and expectations. On top of that, you're taking a discount. So some of these companies were facing double discounts, and that held back some of these deals.
All right, Bailey Lipschultz, a busy man indeed, tracking this IPO market. That is Bloomberg's Bailey Lipschultz. And let's get back to these markets in turmoil. I think it's safe to say the S&P 500 still down quite mightily here. You take a look at the breakdown. We have 70 companies in the green, obviously more than 400 in the red right now. And you look at what actually is doing well. Kroger up at the top, up about 4.5%. Of course, Staples
are killing it.
Well, it's a lot of that is thanks to Kroger. As we were talking about those retailers giving kind of downbeat guides, Kroger actually managed to give an upbeat outlook. There's a lot of questions about their CEO exit. That's helping Staples to outperform, but still down 0.6% on this day where everything is being sold.
Walmart, Costco still down today.
Yeah, well, people go Krogering for the best of everything, including the price.
I've never been.
That's true.
Coming up in the next hour, the CEO of Carrier Global talks impact of Trump's tariffs on his company's products. This is Bloomberg. We are 30 minutes into the sell-off today. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up in the red, tech takes a hit as U.S. exceptionalism falters.
The next test for stocks arrives tomorrow with the non-farm payrolls report for February.
Plus, Trump's tariffs weigh on the C-suite. We'll speak about it with the CEO of Carrier Global. All that and more coming up, but let's take pulse of this sell-off underway right now. Actually, volume is pretty light right now relative to the 20-day average, which is telling, I think. We're still in wait-and-see mode. Things could still turn around depending on what we get at 8:30 a.m. tomorrow, but at least for right now, it's pretty bleak. The S&P 500 down about 1.6%, 1.5%, every sector in the red. A lot of it coming from big tech, with the NASDAQ 100 down almost 2%. We did breach that level a little bit earlier in the pre-market, but currently off the worst levels of the session. The bond market has been a really interesting place because even with this sell-off that we're seeing in risk assets, that we're seeing in equity markets, bond market's not catching a bid today, at least when it comes to the long end of the curve, with your 10-year Treasury yield higher by about 1 basis point, Matt Miller.
Yeah, that I think is fascinating, and that comes as German bonds sell off at a pace that we haven't seen since basically 1990.
Yeah.
Right? You've seen in the last 2 days, German bond yields rise 45 basis points. And that has pushed up yields in Australia, in New Zealand. It's pushed up yields across Europe, in Italy, in the UK. And we see it, I think, in a sense, boosting yields here as well. There you see a great chart of the German 10-year yield. This, by the way, even more interesting as they get ready to borrow another 500 billion euros, right? It's getting more expensive to borrow money.
That is the fuel that sparked the sell-off that we saw in Germany, and that's a sell-off that's really hard for U.S. bond traders to ignore. You think about the U.S. Treasury market. It's the deepest, biggest, most liquid bond market in the world. It's really a global bond market, and some of those global fears that we're talking about when it comes to inflation, what's going on in Germany, that's probably being priced in right now.
You know, I went to turn over to Shake You this morning.
How much do you love this, Sonali?
I don't love chaos, okay? So we have the 10-year back to almost 430. That is 15 basis points higher than where we started the week. So this week in the bond market, the volatility now carrying, is it a diversifier right now? I don't know. It's kind of risky itself.
It's certainly not. You're getting whacked all over.
I mean, I was talking to Gary Cohn at the Invest conference, and he checked on his mobile device.
Everyone was checking
the 10-year yield, and he was like, oh my God, 410.
Incredible.
60 at the time. So it is pretty incredible. Let's talk about this with Carin Pei. She is Fiduciary Trust International Head of Portfolio Management and Equities. International being key here, right, Carin? Because we were talking about, you know, the S&P, it's down more than 6% from its highs, but the DAX is up 20% year to date. The IBEX, the FTSE MIB, they're up 18-19%. So people are rather invest in Italy and Spain and France than the U.S. Why?
Yeah, so I think a lot of it has to do with the markets recognizing that there was a significant valuation differential between U.S. equities and international equities. That's to start. But I also think that the tariff negotiations are definitely creating some uncertainty for the U.S. markets, global markets, in fact. And, you know, I think we just recently this week heard from Germany and other countries, France, talking about, you know, a huge stimulus package to boost their economies to try to counter perhaps some of the tariff war that might be going on right now.
I have to say, I want to talk to the investor who is long Germany, long Spain, long France, and short the U.S., because I don't know if that person
give
exists.
us a ring.
If they do exist, they're having a great day specifically today. But let's talk a little bit about where you hide. We were just talking about the bond market. You had it actually act as that diversifier, as that haven asset to cushion some of your pain that you're seeing in risk assets earlier over the past couple of weeks. Now it seems to have gone the other way. So where are you finding your safety when you're putting together a portfolio?
Yeah, so to your point, I think asset allocation is definitely important, and having a balanced portfolio, rebalancing portfolio risk is key. But within the equity market, I do expect that this year there would be more rotation within the market. You know, in December, when we put out our outlook for 2025, we talked about recognizing that there are some valuation differentials even within U.S. markets, and that not everything moved in the same way. So, you know, we saw opportunities in healthcare stocks, which we view as, you know, GARPy or growth at a reasonable price. We also thought that dividend-yielding stocks would have a better time in 2025, given the valuation differential. So, you know, I think a diversified portfolio is important, especially in these uncertain times.
Given it is so uncertain out there, at what point do you lean in with any conviction? Because to your point that you were making in the commercial break, we're hitting correction level territory, at least directionally.
Yes.
Right? Where do you feel we are going from here? And could we see an actual correction of 10% or more?
Yeah, I think what's going on right now, the market's definitely grappling with a little bit of a growth scare in terms of the economic outlook. We've had a weaker jobs report recently. We have seen services come down a little bit. I think the good news is manufacturing is actually stabilizing, and part of that is that there was a lot of front running in terms of imports, of people trying to get ahead of the tariffs. But I do think that the level of uncertainty right now has risen because of tariff uncertainty, retaliation, and we also are still dealing with some pretty high valuations. So valuation correction could definitely be in the cards for the next couple of months, given this higher level of uncertainty.
We didn't see bad jobless claims, but I'm looking ahead to non-farm payrolls tomorrow, and the survey is 160,000 jobs. But if I type WHIS on the Bloomberg terminal, I can see the whisper number, and you can play along at home as well. They're looking for 120,000 jobs, so well under the survey. A, what do you think about the jobs number tomorrow? And B, are we looking at a real growth slowdown in this country?
Yeah, I do think that it's quite possible that we're going into a slow period, a soft patch, if you will, in terms of the economy, before some of the pro-growth policies start to kick in, right? So right now, the uncertainty around tariffs is definitely bringing down some earnings guidance for 2025 out of a lot of companies that reported during the first quarter. We also do see that there is potentially some noise in the numbers in terms of employment data, claims number, that could be tied to the Department of Government Efficiency, right? We saw that some of that could have maybe even accounted for 1/3 of the recent jobless numbers. So I think that could be some of the things that the market will be looking at as worries about a soft patch.
Well, let's also talk about earnings, because you mentioned the companies reporting. We had a really interesting report from Macy's today, giving not so bad numbers, but the outlook is what we are so focused on. And we've seen that dour outlook come across when it comes to likes of Target, when it comes to Walmart 2 weeks ago. So it seems like, earnings, the picture that analysts are trying to put together about what the next year looks like, the companies themselves too, it's just really tough to do.
Yeah, it's hard to decipher. I think that there is a lot going on in terms of consumer spending. Generally speaking, we do think consumer spending is still pretty sound, pretty firm. I think we continue to see the consumer sort of as the K-shaped economy continues to actually widen more. You have the lower income consumer probably negatively impacted to a greater degree because of inflation concerns. You have companies now that have less pricing power after years of raising prices, right? So companies are definitely, more worried about their profit margins going forward. And we do see that after the first, quarter reporting season, most of the S&P 500 have actually brought numbers down, with the exception of some of the large Mag 7 stocks, which are kind of flattish. But earnings revisions for the 493 are actually down about 5%.
Carin, we thank you so much for helping us decipher what's going on under the market and your moves around it. That is Carin Pei of Fiduciary Trust International.
Thank you.
I now want to bring you some breaking news as well, because Commerce Secretary Howard Lutnick says that President Trump is likely to defer tariffs on all USMCA goods. So since we saw those tariffs really start to take a hit out of the market earlier this week, we have seen already some moves from the Commerce Secretary that has impacted the market, and certainly his comments impacting the market today. He said that USMCA goods-related tariff delay is likely until April 2nd, which we generally knew that. That April 2nd deadline now, guys, is a significant one.
Well,
right?
this to me is very confusing, because on April 2nd is when we see reciprocal tariffs. You'd guess most of that is going against Europe, right? USMCA is an agreement between Mexican, U.S., and Canadian producers, and those tariffs went into effect a couple of days ago.
Right.
Then yesterday, Ford and GM get a reprieve because they're USMCA compliant, and I guess so are all producers in the U.S., Canada, and Mexico.
And it's worth pointing out that the USMCA, that was a trade deal that Trump negotiated in his first term. It was
with
one
Gary
of his,
Cohn, whom I spoke with.
You keep name dropping
a couple
that.
days ago
Matt
at the Invesco
Miller
conference.
spoke with Gary Cohn.
They
in
have a
case you
few
missed
things
that.
in common.
But Howard
both
Lutnick,
bald.
of course, this is a fluid situation, and what we know is that this is moving the market. The S&P 500, it's still down about 1%, but it was down about 1.6% a little bit earlier. So a little bit of
Canadian dollar
relief there, I will say. One thing I wanted to point out, we did have a viewer write in. I made the joke that I want to talk to the guy who's long Europe, specifically Germany, Italy, Spain, and France, and underweight the U.S. That man was watching, and he is a Bloomberg terminal user, so there you have it.
We should get him on.
We should
write back. Will you come on our show?
He's had a great year-to-date performance in his fund, so
show me what's in your wallet. Anyways, I will also point out here in a social media post, because the social media posts from the president are what's also what markets are paying attention to. The president says he will change the trade deficit in a social media post. Of course, trade is really the key story of the week, potentially of the next month at the very least. We're going to get a look at stocks moving under the surface this hour with Bloomberg's Emily Greifeld. Emily, what's moving?
There's a lot going on right now, guys. I know you guys already mentioned Marvell Technology. It's down as much as 20%, its biggest intraday drop since 2015, and it's all about its earnings. This is a chip maker that reported a revenue forecast that fell short of the highest estimate. So the results actually weren't that bad, at least according to Vital Knowledge. But again, it shows that even though there's nothing bad in the release, obviously inline isn't good enough for a type of name, particularly on these days when we're really seeing risk-off effect. The chip names, the AI names, those tech stocks, this was not a good day to be reporting something that just hit analyst expectations.
All right, in terms of what's going on with SMCI, with Broadcom, with JD.com, we see a lot of these companies moving around, not only Marvell, but also China.
Yeah, that's right. I feel like it's important to note out JD.com ADRs, because that's a pocket of the market today, at least, that you can find some green on the screen. That stock was up, or the ADRs were up as much as 6% on a net revenue beat. The company actually posted its fastest revenue growth in almost 3 years. I guess maybe China is a place to hide in this market, at least on today, because those earnings did reflect boosting consumer spending across the Chinese economy. Again, JD.com, a Chinese e-commerce company, but it wasn't the same for those AI names, both SMCI and Broadcom really falling today. It's in part on this risk-off move, but also I think traders getting a little nervous ahead of the Broadcom earnings. SMCI reported last week. It was a miss. Broadcom is reporting after the bell today.
All right, Emily, great roundup as always. Emily Greifeld is also a fantastic ETF reporter. She has a fantastic story out today on the terminal and online as well about First Trust and the drama that's unfolded in Wheaton, Illinois. Great story from Emily Greifeld, but I'm actually going to talk about myself right now because I also had a story out this morning on ETFs. Bridgewater out the door with its first ever ETF in partnership with State Street, who, as Sonali knows, has had pretty rocky week, I think it's safe to say, but they're launching Ray Dalio's famous all-weather strategy in ETF form. This is something he created in the 90s. It's a form of risk parity where you basically allocate to different asset classes based on their levels of volatility. And risk parity hasn't been super hot over the past couple of years. It's been outperforming, but this year, and I don't think we have any charts that can back it up, but this year it's outperforming both the 60-40 portfolio and as well as the S&P 500.
You're just going to have to trust us on this one, but you can go to HFGO on your Bloomberg terminals for what hedge fund returns are doing this year. And to your point, Katie, not only is it outperforming this year after kind of, let's say, many years of struggling to perform, it also is made for this market.
That's the thing.
People buy into this when things get tough. It's supposed to be the ultimate hedge in terms of being a hedge fund. Let's see if it works for the retail investor, though, this time around.
That's the thing. We were talking about where people are finding safety. They're looking to alternative type of strategies, such as this, such as risk parity, in a market like this where it feels like everything is going down at once.
Crazy time, crazy day to launch something new.
All right, well, check it out. ALLW equity on the Bloomberg terminal. We are watching market gains or market losses paired slightly. As Katie said, we were down 1.6% on the S&P 500. Now we're down less than 1% after Howard Lutnick came out on CNBC and said Trump is likely to defer tariffs on all USMCA goods. We're going to continue to follow that story, obviously, for you very closely. We're also going to take a deeper dive into the chip meltdown as AI competition out of China threatens U.S. semiconductors, and Broadcom gets set to report its latest results. We'll have a preview next. This is Bloomberg. Let's get now to high interest and look at what's making headlines around the world. German bonds extending their rout with debt markets around the world sliding in the wake of Berlin's historic plan to spend hundreds of billions of dollars for defense and push for even more from EU compatriots. Yields on 10-year bunds climbed and continued their march towards 3%, up 45 basis points in 2 days. That's the biggest increase since the fall of the Berlin Wall. And as we've been telling you, that sell-off reverberated through global debt markets, with Japan's government yields reaching their highest level in more than a decade. Yields in Australia, New Zealand, Italy, the UK, and the US all rising. The Commerce Department here in America is tapping former Morgan Stanley banker Michael Grimes to lead a planned sovereign wealth fund. The public-private fund is part of President Trump's effort to give the U.S. a stake in projects he considers critical to national security and to bring in large-scale institutional investment. The Commerce Department didn't respond to a request for comment, and Grimes couldn't be reached personally, but during his 30-year career at Morgan Stanley, he worked with Elon Musk on his purchase of Twitter. And a spate of new artificial intelligence tools from China sparked frenzied buying in the nation's stock market, pushing the Hang Seng Tech Index to its highest level since 2021. Alibaba paced the gains after unveiling its latest open-sourced AI model, which uses just a fraction of the data DeepSeek's R1 employs. The flurry of AI announcements included Tencent's new open-source video model, Hunyuan, and a similar product from Kuaishou Technology. Earlier this week, Manus AI launched a bot it says can perform tasks better than OpenAI's deep research on some fronts. Katie?
Well, let's stay on tech because Broadcom releases its latest results after the bell today, and it really comes at a time where chip makers are facing increased competition from China and the threat of the CHIPS Act repeal from President Trump. Joining us now from London is Kunjan Sabani. He is senior chip analyst over at Bloomberg Intelligence. So looking at Broadcom specifically, it seems like AI sales expected to do quite well, growing about 62% in the latest quarter. But in your opinion, is that going to be enough to lift the fog that's hanging over this stock and the sector as a whole?
Well, if I go based on what we saw with NVIDIA, which beat handsomely, and what we saw with Marvell just yesterday, a good proxy of the reaction we could see from Broadcom because they're very close competitors. I guess unless you're beating by strong and meeting all the loftiest estimates, that is not good enough. Fundamentally, we expect Broadcom to stay intact with their AI revenues growth from custom and connectivity to continue ramping through the year and stay pretty strong. But I don't know if a regular beat and raise would be strong enough to offset this de-risking that's going on with semis.
On Broadcom, it's already down about 20% this year. So it's kind of sold off in the fray as we saw news that, to your point, maybe beat in some cases, but not by enough. Has it sold off enough, or do you think that there's a lot more downside risk based on what we could hear tonight?
I mean, I think it has to be with the magnitude of what they say. Look, if they come out and give a strong new target for AI revenues this year, I think that should suffice to stop this sell-off. I think if they come and beat their numbers significantly, which they don't have a habit to do, but if they do, especially on the custom side due to Google's ramp, if they give any material quantifiable data point, that should be good enough. But if it's just an inline, regular beat and raise like what we saw with Marvell, I suspect we could see some headwinds there.
All right, Kunjan, great preview. Really appreciate your time. That is Kunjan Sabani of Bloomberg Intelligence joining us from London. This is Bloomberg.
Uncertainty over Trump tariffs is already having impacts on the Mexican economy. The country's aim to attract foreign investment and boost U.S. exports has begun to falter due, in part, to the president's plan. Let's talk to someone with boots on the ground in the country. Joining us is David Gitlin, Carrier Global Chairman and CEO. Carrier is a worldwide manufacturer of heating, air conditioning, and refrigeration products. Obviously, a lot of those are being used to ship goods across the border. How are you experiencing these tariffs and the volatility, really, of them?
Well, it's certainly fluid, Matt. We are taking the same approach as we've taken with everything since we spun 5 years ago. We dealt with COVID, we dealt with supply chain, and we're just taking a very measured approach. We have a three-prong attack plan. One is that we do have to deal with pricing, and we will in a very judicious way. Second is we're going to work with our suppliers. They need to share in some of the pain that we'll be enduring. And then the third is that if that is not enough, we will take cost out somewhere else in the system.
So we spoke to Howard Lutnick on Bloomberg Surveillance yesterday. He's been making the rounds across the networks, but yesterday on our network, he said that it's not that you're seeing all businesses put their investments on hold. And I'm curious how you're managing it. Obviously, as you just walked through, there's a lot of different cross currents right now. But when it comes to spending plans, other types of planning, headcount plans, are you in a wait-and-see mode as we kind of go back and forth on whether or not these tariffs will actually go into effect?
We have long-term investments that we will stay the course on because there's so many secular tailwinds in our industry that we do continue to invest in capacity. We do continue to invest in R&D, and we are going to stay the course on those. While these play themselves out, we may come out of the gates a little bit slower on spend in the first quarter, second quarter, while we see how the tariffs completely play out. But for many, the bulk of our investments are long-term in nature, and we will continue to stay the course.
Talk us through your pricing strategy. You alluded to it just a minute ago. How much range is there on how much things can move for you depending on how things shake out?
The good news is that we do have some pricing flexibility in our industry, but we do need to be judicious. We do have elasticity curves. We are concerned always about our customers and their ability to afford and absorb some of those price increases. So we'll have to see exactly where some of the tariffs land. The one that we focus on in particular is Mexico. We do have operations in Mexico. So we'll see where the exact level lands, and then we'll find the kind of the right balance with our distributors and our dealer partners.
So as we said, Commerce Secretary Howard Lutnick on CNBC right now saying that Trump is likely to defer tariffs on all USMCA goods. And he says that 50% of imports from Canada and Mexico comply with the USMCA. Does that include Carrier?
100%. Yeah, so we do comply with the USMCA. So Hopefully that...
What does that mean, by the way? Compliance with USMCA? I mean, who doesn't comply with USMCA?
Yeah, I actually think, my understanding is it's something like 85% comply with the USMCA. We're certainly in that category.
Well, that is good news then. And let's talk about some other potential good news. I want to switch gears and talk a little bit about data centers. Obviously, one of the fastest growing markets out there for thermal management markets, including HVAC producers and including for carriers.
I love that term, thermal management. That's cool.
That's another one I had to think about. Exceptionalism and thermal management market. But talk to us about how you're positioned there. Yeah.
We're very well positioned. So you think about a typical commercial office building, it may have 3 chillers. We have recently won a data center with one of the hyperscalers. It'll have 140 chillers. So you think about the heating requirements for a data center, they're unlike anything that we've ever seen in our industry. So the demand is great. We've been winning more than our fair share. Our data center revenues last year were about $500 million. This year it's going to be about $1 billion. Our order book continues to grow exponentially, which positions us well for continued growth in 26 and 27. So it's a great vertical, and we have some unique solutions because you have traditional cooling, and then you also have a new liquid cooling, which is direct to chip. And we can now, with our collective offerings, be a one-stop shop for the data centers where we can do all of their cooling needs. Let our customers, the hyperscalers and colos, worry about running the data centers. Let us really worry about cooling them.
You know, the ripple effects of the need for data centers, this AI boom is pretty staggering. You have the real estate, you have the energy needs, you have the HVAC cooling needs. Yes. We had a report overnight about what's happening in China, too, and how they're developing models. Alibaba's open source model, really just using a fraction of the data that DeepSeek's R1 employed. So that caused another kind of spooking of the market, if you will. So how do you think about this from where you sit? The variability in the needs for the data centers in the U.S.?
When we look at data centers, for us, it's kind of a perfect combination where we're not overly exposed to it. Right now, it's a little bit less than 5% of our total sales, but it also is providing tremendous tailwind. So we look at our order book, we look at the demand over the next 5-7 years. It looks really solid, it looks very, very strong. So the hyperscalers last year spent about $250 billion on CapEx. This year, it's going to be about $330 billion. So like any growth in the area, it may not be a perfect line, but the line does go up and to the right.
What was you were talking about massive numbers yesterday when it comes to data centers.
Right. If you really do the math on what BlackRock said publicly, it adds up to $15 trillion in spend that's needed. But the lower end of the range is $1 to $2 trillion. So the delta between $2 trillion and $15 trillion, they both can't be true.
But that's why your stock is up 500% in the past 5 years, right? I mean, you're handily outperforming any benchmark out there. You seem a little bit understated when you're talking about, the outlook.
No, we're very excited about the overall outlook in data centers in particular. I mean, we're very well positioned with data centers. Our commercial HVAC business has grown double digits 4 years in a row. This will be the 5th year in a row. We've increased our amount of recurring revenues so we can smooth some of the cycles. So our aftermarket business has grown double digits 4 years in a row. It'll grow double digits this year. So when we look at our exposure to a lot of the secular trends, we feel really good about U.S. residential. Our business this year will be up high single digits in U.S. residential. We made a great investment in Europe, and we see Germany showing just the very beginning signs of stability and fiscal stimulus in Germany, which is overdue and much needed. And we believe the new chancellor is going to invest $500 billion in infrastructure. And we like our exposure globally. So we're a focused pure play company, but we're also well positioned globally.
Well, that's where I wanted to go, exactly, to Europe. You mentioned you recently closed on a deal there. I'm not going to try to pronounce that.
Wiesmann.
Wiesmann.
Yeah, yes.
Wiesmann. A little bit more difficult than thermal management. It sounds like,
and exceptionalism.
It sounds like you're pretty optimistic there, but you referenced some of the factors going on there. We have the German election as well. I mean, just talk us through the base case there and how you see Europe as positioned versus the U.S. versus Mexico, for example.
We are very pleased with, frankly, the fact that the election played out. We got certainty much earlier than we otherwise would have. We're probably going to end up with a two-party coalition, which for us is kind of the best combination of both worlds. With the Christian Democrats and Frederick Merz, you are going to see some fiscal conservatism and more stimulus spending, so fiscally. So that's very good for us.
Now, those two things are kind of counter to each other, right?
Well, they're going to partner a bit, Matt, but they're also going to partner now with the Social Democrats. So I think that the continued shift to renewables, today 60% of the power in Germany comes from renewables, so that will continue. That train has left the station. So the big shift that's happening in Germany and across Europe is homes that are powered by boilers, whether it's gas or oil, are shifting to electric heat pumps. When that happens for us, we mix up by 3 to 4x. So that transition has happened. It will continue to happen. And even at the rate it's going to continue, only 20% of the homes in Europe will have heat pumps in 2030. So we see this trend continuing, and we see that providing tailwind growth for years to come.
All right, David, it's great to get some time with you. Really interesting around the world conversation. That is David Gitlin of Carrier Global, a hot stock talking about really hot data centers.
Too hot.
Yes. Exactly. You know what isn't too hot right now? It's the stock market. What a segue. The S&P 500 down about 0.8%. Again, we're off our worst levels of the session, but boy, that has come with a lot of volatility. The NASDAQ 100 still your biggest loser on the downside. Not as much as it was earlier, down about 2% at one point, but those chip stocks still weighing the index down about 1% ahead of Broadcom reporting after the bell. And then you take a look at the bond market. You're not going to find any safety there, with 10-year Treasury yields higher by about 5 basis points, Sonali.
433. I can't believe it.
It is crazy. I'm right there with you.
Wowza. All right, we're going to get a look at stocks moving this hour with Bloomberg's Emily Griffeo, because as the market is not tanking as much, either is Macy's.
Yeah, that's right. I mean, Macy's, the results were actually pretty good, but the outlook wasn't as good. And that is kind of the theme that we're getting for retailers across the board. But that stock is paring losses. It's still in the red, though. The company's net annual sales forecast for $21 billion to $21.4 billion missed estimates. Their EPS forecast also missed. And you can kind of get a read on the consumer from the comments from Macy's CEO. He said consumers are under pressure navigating food prices, the cost of housing, and the stubborn inflation rate. Yet, they still want to indulge at times on things that make them happy. At least that was according to Macy's CEO, Tony Spring. So a mixed bag, and you can kind of see that resulted in today's trading in Macy's.
I was singing the Kroger jingle earlier, and I don't think anyone on set.
No.
I don't think I know that.
No
Got it.
idea.
Because I'm from the great state of Ohio.
I do the Stu Leonard song.
Yeah, well, see, that's like a New Jersey, New York thing.
There you go.
And I don't know where you shop, but
The avocado song.
Kings.
Kings?
Yeah.
Is that a New Jersey?
Yeah, it's a grocery store.
New Jersey grocery store?
It's a really fancy one, Matt.
Well,
does it make inflation feel less bad?
Yeah?
I don't know.
Oh, yeah.
The
Well,
avocado song?
I mean, the avocado song I like.
You know, Emily has some great stuff to tell us about Kroger.
Yeah, what do you have to tell us about Kroger? Can you please tell us what the CEO did?
So they're having a CEO switch up right now. I don't know if he's singing the Kroger song, and I don't know if I can repeat the Kroger song. I don't think I know it. But it was a similar story with Kroger as with Macy's. The forecast for the full year missed. They see adjusted EPS $4.60 to $4.80. That was slightly missing estimates of $4.82. And also the company's adjusted earnings forecast for the fiscal year was lower than expectations due to lower pharmacy margins and investments. So this is a grocery company, but the pharmacy margins were lower, and that's weighing on the stock.
What did he do? Does anybody here know what he did?
I don't. We only know what the company has told us so far, which it seems like is not a lot. But Kroger has been an interesting story, of course, with the CEO change, with that M&A that didn't quite work out. Also interesting, Emily, is Victoria's Secret.
Yeah, this stock, this is down 50% year to date, Victoria's Secret. It's been plunging for 8 straight days. And so to have earnings come here where a forecast miss, it's just setting this stock up to really tank today. And that's what it's doing. Down, the company cited an uncertain backdrop, shift in consumer confidence. Analysts at both BMO and JP Morgan cut their price targets on the stock. I mean, that's not really a hard decision to make after, again, the stock is down 50% year to date.
Is it not popular, the lingerie at Victoria? Is it?
Very.
But surely there's more expensive and better stuff.
There certainly is, but in this economy, you know, maybe you want to save a few bucks.
You go discount or you go ultra luxury.
But Emily was just saying, people are feeling like they want to spend a little bit on themselves, you know? And then I guess a teddy is what I would buy if I wanted to spend a little bit on myself.
You know what I would buy? An index fund.
So apparently would Steve Mnuchin, is what he said this week. So that's some smart investing. Anyways, we're going to leave it there for now for this. Coming up, we're going to talk about faith-based investing because it's on the rise in the United States. We're going to bring you Wall Street Week and take a look at the growth of faith-friendly funds and how it's impacting companies. This is Bloomberg.
All right, it's time for our Wall Street Week conversation. And total assets in faith-based funds surpassed $90 billion in the past 2 years alone. Bloomberg Wall Street Week host David Weston explores how these funds decide what companies to invest in and the impact on DEI efforts.
Brandon Pizzurro is the president of Guidestone, a faith-based investment firm tracing its roots back to 1918, when it was started to support retired Southern Baptist ministers and their families. Today, it manages over $24 billion in assets.
So we leave out 5 key areas. That's abortion, alcohol, tobacco, sexual immorality, and gambling. But there's also other areas, as I mentioned earlier, that are antithetical to our moral and ethical posturing, such as predatory lending, THC or cannabis production, even private prisons. But you're really only screening out a couple of percentage points out of some of the major indices, the Bloomberg Aggregate Bond Index or even the S&P 500.
Are you growing in the number and the size of investments you have?
We're certainly growing. It's been a slow burn. I think that's for all of us in the faith-based investing ecosystem. There continues to be growth. We believe the ecosystem for liquid securities in a faith-aligned manner are about $100 billion. Our mutual fund complex is about 20 billion of that. But there certainly can be more than multiples of that, 2 to 3 times. But some of the most current estimates are around that $100 billion mark. We're not activists. We do engage in corporate engagement. Certainly on the margin, we'd like to have our voice heard where we can, but we're not going after companies, so to speak. That's not the way in which we're seeking to have change.
I'm not arguing that corporations should never do anything good for their community. What I'm arguing is they should engage in ways that are not divisive. But about those, so-called faith-based investors who embrace DEI, I think that it's based on false doctrine, and, Christians would call it heresy in many ways.
Robbie Starbuck is every bit the activist that Pizzurro says he is not. He's made big news by pushing companies to abandon their diversity, equity, and inclusion efforts, and he's had more than his share of success.
A push against DEI has spilled into corporate America, where the legal assault on diversity initiatives has actually gathered some steam.
McDonald's is no longer setting aspirational representational goals. The company is retiring its DEI pledge in its supply chain and renaming its diversity team as the Global Inclusion Team.
Walmart is reversing course on diversity, equity, and inclusion initiatives, joining a growing list of businesses retreating on DEI programs targeted by conservative activists.
I've had these conversations with CEOs at major companies where they've asked, okay, if we're getting rid of all these things, what are things you do think are not divisive? And I'll give them a list of things that I don't see as divisive that I think everybody could broadly accept as good. Like, look at JP Morgan. They spent $30 billion on racial equity, and it's a very broad term. But the way that they spent that money, in my view, is terribly irresponsible, and it didn't do a service to the shareholders. It's like DEI in theory versus DEI in reality. I'm the one holding up a mirror of what it actually is in reality. Because in theory, a lot of people really like the theory because it made them feel good. It's like warm, fuzzy words, right?
And that was David Weston on faith-based investing. You can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg. All right, let's get a check on these markets right now. Still in sell-off mode on pretty light volume, which I find interesting. Down about 9% in terms of the average, the 20-day average when it comes to trading volume. The S&P 500 off by about 0.7%. It's your big tech names that are leading the indexes lower right now, with the NASDAQ 100 off about 1%. Again, that was a 2% drawdown earlier, so coming back a bit, and the 10-year Treasury yield continuing to climb. Let's talk about the economy, because tomorrow the February job report is expected to show that payrolls increased by 160,000 jobs. Let's talk about it with Michael McKee. He is Bloomberg's chief international economics and policy correspondent. And we've gotten a lot of labor data this week. Put it all together for us and what we're expecting at 8:30 a.m. tomorrow.
Well, we started today off in not a particularly great way with the Challenger Gray and Christmas layoff announcements. But while that's not a high frequency or high quality indicator, you can see well, hold on just a second. We're a little ahead of ourselves with the chart there. We had the biggest increase in the layoff announcement since 2009. Then we got jobless claims, which go the other way. They fell by 20,000. This is the federal workers in the jobless claims numbers, and they did go way up, but it's only 1,600 federal workers filing this last week. We'll get more as the weeks go on. So basically where we are is going into tomorrow, we've got mixed pictures. And so the forecast is for 160,000 and no change in the unemployment rate. But the whisper number is 120,000. So there's a big divergence between what Wall Street is thinking and what economists are thinking. And so we could have certainly volatility tomorrow.
Put the Doge layoffs into perspective for these numbers for us, Mike.
Well, the biggest thing about the Doge numbers, and I showed you the federal workers, that was for the week that they began all these layoffs. And so that won't show up in tomorrow's numbers because the pay period that includes the 12th was before all of this began. So we won't see a huge impact from that this month. Next month, we will. But the question that comes from this and the ADP numbers is, are we seeing a lot of layoffs starting or hiring contracting because people are worried about the economy slowing down? I do have one other really interesting thing to show you, and that's these trade numbers we got today.
Yeah, tell us.
Hang on, before we get there, can I just say, I think Sonali's, because we were talking about this morning, question on Doge is more than just what is it this week or this month. The idea that if the federal government fires 300,000 people, does that result in 500,000 job losses? Does that result in 1 million job losses?
Well, there is a multiplier, but we don't know what it's going to be exactly yet. Depends on where the layoffs take place. You have a lot of federal contractors out in the Virginia suburbs, for example. There's not going to be a lot of restaurants around there, but people who are laid off in Washington, D.C., restaurants and shops and things like that will suffer. So there's going to be a multiplier effect, and nobody has a good idea yet.
You know, I do want to cite Anna Wong's number over at Bloomberg Economics because they expect not only a weak print, they could even expect a negative print, which is not in their baseline, but within their confidence interval. So a lot of variability there.
Yeah, we'll have to wait and see there, of course. Anna Wong, known for taking big swings. We'll get the answer soon enough. What's interesting to me, Mike, is that, okay, we have 8:30. That will be exciting. Then we're going to hear from the man himself, Jerome Powell, speaking tomorrow. What might we expect? It seems like he's been hesitant to make too much news or comment too directly, of course, on fiscal policy.
Yeah, somebody pointed out yesterday that some really handsome, smart guy interviewed John Williams.
I heard about that.
From the New York Fed
pointed that
week.
out.
And John basically said tariffs add to inflation, but we don't know whether it will be inflationary over a period of time because we don't know how the president is going to do this. If you do it once, you get a one-time jump. If he keeps putting on tariffs month after month after month, you'll have inflation. And we don't know what that's going to do to inflation expectations. So I expect that the chair will say something along those lines. May not go as far as John in saying nothing's going to happen on the 19th, but
Mike, we just have 30 seconds until the hard break. You were going to say something on trade.
Yeah, we had a record trade deficit, 131 billion, and we had that big rise in imports. 34 billion of that was gold bars.
Oof. Oh, boy.
So people are trying to get their money out of Europe and into the United States before the tariffs. Yes.
Yeah.
All right, Michael McKee, we're going to hear from him a lot tomorrow. Coming up tomorrow on Open Interest, Gargi Chaduri joins us from BlackRock and Tiffany Wilding of PIMCO.